Leaving your money sitting untouched in a basic savings account feels like the ultimate safe move, but doing nothing is actually a guaranteed way to lose wealth. Those basic accounts pay a tiny 3 to 4% interest. Meanwhile, the cost of living rises much faster, silently eating your purchasing power. To actually outpace inflation, you need to secure high-yield deposits, paying up to 8.5%. And you can lock in these rates with absolutely zero market risk because the RBI legally guarantees deposits up to 5 lakh rupees per bank. Even if a smaller finance bank goes under, your cash is completely protected by the government. The main drawback? High-yield deposits lock your money away for years. To fix this, you split your lump sum into smaller buckets. You set them to mature at staggered intervals, like 1, 2, and 3 years. This continuous cycle of unlocking cash is called FD laddering. It guarantees a portion of your money becomes available annually for emergencies without breaking any terms. So instead of watching your savings slowly shrink, your cash outpaces inflation, stays fully insured, and is always within reach.
Fixed deposit laddering gives you high interest without trapping your money. But how exactly does it work? Putting all your savings into one massive FD means paying penalties if an emergency strikes. Say you have 3 lakh rupees that you want to grow, but might need over the next 3 years. If you lock all 3 lakhs in a single 3-year deposit, an early emergency withdrawal breaks the whole fund and triggers a penalty. You want that high 3-year compound interest, but you also need 1-year liquidity. Instead, you build a ladder. You split those 3 lakhs into 3 separate 1 lakh deposits. Each one gets a different maturity date, 1 year, 2 years, and 3 years. After exactly 1 year, the first deposit matures. You get 1 lakh in liquid cash plus interest, while the other 2 keep growing. As year 2 and year 3 conclude, the next deposits unlock right on schedule. This creates a continuous, penalty-free stream of cash every single year. And what about those 3 lakh rupees you started with at the very beginning? They earned maximum compound interest over 3 full years, without ever leaving you trapped. Think keeping your money in a basic savings account? Thanks to inflation, that cash earning 3% or 0 in a current account is actively losing its purchasing power. To beat inflation with zero market risk, you have to use the specific growth tools banks offer. First up, recurring deposits. This is the ultimate tool for steady earners. It automates a fixed transfer from your paycheck every single month. This forces disciplined savings while locking in a guaranteed 5 to over 8% interest rate. Next, fixed deposits. This is your shield for lump sums like a bonus or property sale. FDs pay up to 8.5% by compounding, meaning your interest starts earning its own interest. This prevents major windfalls from slowly bleeding away to daily expenses, growing them safely instead. And finally, the safety net. What if the bank completely fails? The RBI automatically insures your bank deposits up to 5 lakh rupees through the DICGC. You can aggressively chase high-interest FDs across multiple banks, knowing your baseline principal is legally protected. True financial safety isn't hoarding cash. It's matching your income style with the right bank products to outpace inflation.
Leaving your money in a basic 3% savings account guarantees one thing: it will lose value to inflation. Here are 4 ways to double that yield with zero market risk. First up, match the account to your income. A recurring deposit handles monthly salary drips, while a fixed deposit is meant to lock in a sudden lump sum. Both can unlock top-tier interest rates of up to 8.5%. Next, use the compounding engine. High-yield accounts don't just pay a flat rate, they pay interest on the interest you've already earned, automatically accelerating your growth over time. Third, build an FD ladder. Instead of locking a massive sum into one timeline, break it into 1, 2, and 3-year chunks. This ensures you always have cash available without paying early withdrawal penalties. Finally, the ultimate safety hack. The RBI guarantees only up to 5 lakhs per bank. So if you have a massive 20 lakh fund, divide it across 4 different top-yielding banks. This ensures every single rupee stays 100% legally protected. By combining the right deposit type, staggered timelines, and multi-bank spreading, a basic bank account becomes a highly optimized, risk-free financial engine. Leaving your cash in a standard savings account feels safe, but you're actually losing money. Inflation eats that tiny yield alive. But you can beat it with 3 zero-risk banking strategies. Strategy 1. lock in high-yield fixed and recurring deposits. While a savings account barely keeps up, FDs and RDs currently offer up to 8.5% guaranteed. Your money outpaces inflation through compounding interest, completely untouched by stock market volatility. Next, never lock a massive lump sum into just one account. Instead, use FD laddering. You split your money into separate 1, 2, and 3-year chunks. This ensures a portion of your cash matures every year, right when you need it, avoiding early withdrawal penalties. And finally, exploit the federal insurance limit to protect huge deposits. Default RBI insurance only protects up to 5 lakh rupees per bank. A massive deposit is dangerously exposed, so savvy depositors split large sums across multiple different banks. Now every single rupee is federally protected. By deliberately structuring how and where you deposit your cash, passive savings transform into an active, fully protected financial engine.